When we talk about Dogecoin, the first thing to remember is that it wasn't even meant to be taken seriously. Back in 2013, two software engineers created it as a parody of Bitcoin, using the famous Shiba Inu meme as its logo. It was supposed to be a light-hearted joke in the crypto space, a reminder not to take things too seriously. But here we are, years later, investment, with Dogecoin trading on major exchanges, backed by online communities, and even making headlines whenever a celebrity tweets about it. The question we need to ask is, does something that started as a meme really have the potential to be a smart investment, or is it just hype? Now, the reality is that Dogecoin is one of the most volatile assets you could ever put your money into. Its price movements are not driven by company earnings, cash flow, or intrinsic value like stocks are. Instead, investment. They're driven almost entirely by speculation, social media buzz, and market sentiment. One day, it can skyrocket after a viral tweet, and the next, it can lose half its value just as quickly. That kind of unpredictability makes it extremely risky. For some, that risk translates into excitement, but for most investors, it means sleepless nights and unnecessary financial stress. The other problem is sustainability. Unlike Bitcoin, which is capped at 21 million coins, Dogecoin has no maximum supply. That means millions of new coins are entering circulation every day. And when supply keeps growing without any real demand to back it up, it becomes very difficult for the price to hold steady in the long term. Many people buy Dogecoin because they hope someone else will pay more for it later. That's not investing, that's speculating. And speculation is like rolling dice at a casino. Some people win big, but most end up losing. So what's the truth? Dogecoin is not inherently bad, but it's not the kind of asset you build your financial future on. If you want to take a small gamble with money, you can afford to lose. Sure, Dogecoin might give you a thrill, but if you're serious about building long-term wealth, you need to focus on assets that generate real value. Whether that's through cash flow, dividends, or innovation, the smart way to look at Dogecoin is as a tiny slice of a diversified portfolio, not as your main investment strategy. That way, if it takes off, you benefit. But if it crashes, your financial future doesn't crash with it. Dogecoin's story begins in a very unconventional way compared to most investments. Unlike companies that go public after years of growth or cryptocurrencies that aim to solve real-world problems, Dogecoin was launched in 2013 as a parody. The creators, Billy Marcus and Jackson Palmer, investment, wanted to make fun of the hype around digital currencies at the time, and they used the popular Shiba Inu meme as the logo. What started out as a joke quickly gained traction online because it was fun, approachable, and had a strong community spirit behind it. Unlike the complicated language surrounding Bitcoin or Ethereum, Dogecoin's appeal was that anyone could participate. It was simple, humorous, and felt more like joining a movement than buying a piece of technology. That accessibility played a big role in why it spread so quickly, especially among younger investors who wanted to be part of something exciting. Over the years, Dogecoin transitioned from being a mere internet joke to a serious talking point in the financial world. People began using it for tipping online, donating to causes, and building a sense of digital culture around it. This strong community gave Dogecoin an unusual kind of credibility. Even though it didn't have the same technical strengths as other cryptocurrencies, investment had people who believed in it, promoted it, and treated it as more than just a meme. The fact that a currency born out of humor could gain enough momentum to be traded on major exchanges, supported by celebrities, investment, and discussed on mainstream media shows just how unpredictable financial markets can be. It highlights the reality that perception, popularity, and social influence often carry more weight in the short term than fundamentals or technology. But here's the interesting truth. And Dogecoin's rise says more about human behavior than it does about the strength of the asset itself. Investors weren't buying Dogecoin because it had limited supply, groundbreaking utility, or cutting-edge blockchain technology. They were buying it because it was fun, cheap per coin, and had the chance of going to the moon if enough people got behind it. That psychology, fear of missing out, investment, combined with the thrill of quick gains, helped turn a joke into a billion-dollar asset. Dogecoin became proof that in modern investment, narratives and emotions can move markets just as powerfully as financial fundamentals. So when looking at Dogecoin's origin, we see both its strength and weakness. Its strength lies in its community-driven growth and cultural influence, while its weakness lies in the fact that it wasn't designed with long-term value in mind. Understanding that contrast is the first step to seeing Dogecoin for what it truly is, not just a digital coin, but a case study in how hype can transform a joke into a serious investment consideration. When it comes to Dogecoin, one of the biggest truths investors need to face is its extreme volatility and risk factor. Unlike traditional investments such as stocks, bonds, or even real estate, Dogecoin doesn't have any intrinsic value or fundamentals to anchor its price. With a stock, you can look at earnings, revenue growth, or dividends to measure whether it's a worthwhile investment. With real estate, you have cash flow from rent and long-term appreciation. But with Dogecoin, the price is driven almost entirely by speculation, hype, and social sentiment. That means the market can swing wildly in a matter of hours, creating both massive gains and equally devastating losses. For an investor, that unpredictability is the very definition of risk. Investment. Dogecoin's history makes this point very clear. There have been times when it shot up by hundreds of percent in just a few days, often after a high-profile mention on social media. But just as quickly, it has also collapsed, leaving latecomers holding huge losses. That type of volatility isn't a rare occurrence. It's part of Dogecoin's DNA. With millions of new coins being created every single day, there is constant downward pressure on its price unless demand keeps rising to absorb the supply. This makes it difficult for Dogecoin to sustain high prices for long periods, and it leaves investors vulnerable to dramatic drops the moment hype dies down. The other layer of risk is that Dogecoin doesn't have a clear roadmap for growth. Bitcoin, for example, is often described as digital gold because of its limited supply and growing institutional adoption. Ethereum is seen as the foundation for decentralized applications and smart contracts. But Dogecoin doesn't have the same utility or development backing. It exists largely as a speculative asset to rent, and that means investors are essentially betting on other people's enthusiasm rather than on long-term innovation or adoption. This puts Dogecoin in a category that is closer to gambling than structured investing. For the average investor, it's important to recognize that high volatility can be exciting when prices are moving up, but it can be financially devastating when the trend reverses. Makes a good investment. Many people are drawn in by stories of overnight millionaires, but what often gets ignored are the countless others who bought near the top and lost much of their savings. That's why risk management is so critical. Investing in Dogecoin should only ever be done with money you're prepared to lose, because there is no guarantee it will hold value over time. Understanding this risk factor is essential if you want to avoid turning an investment into a financial regret. ChatGPT said, one of the biggest truths about Dogecoin is the difference between speculation and long-term value. Most people who buy Dogecoin are not doing so because they see it as a revolutionary technology or because they believe it will generate real world utility. Instead, and they are driven by the hope that the price will go up quickly, allowing them to sell for a profit. This is speculation, the act of buying something primarily because you believe someone else will pay more for it later. And while speculation can sometimes generate fast returns, it is not the same as building wealth through long-term sustainable investments. When we look at assets with long-term value, everything may usually clear fundamentals backing them. Stocks represent ownership in companies that produce goods, provide services, and earn profits. Real estate produces rental income and tends to appreciate over decades. Investment, even Bitcoin has the narrative of being digital gold due to its scarcity and decentralized nature. Dogecoin, however, lacks that kind of strong foundation. It has no supply cap, meaning billions of new coins can be created indefinitely. This unlimited inflation makes it very difficult for Dogecoin to retain or grow its value over time, because the supply keeps expanding while demand is unpredictable. Another important point is that Dogecoin has limited use cases compared to other cryptocurrencies. While it can be used for tipping online or making small payments, it has not been widely adopted by businesses or financial institutions. Without broader adoption, it struggles to prove its utility beyond being a speculative trading vehicle. The reality is that many people don't hold Dogecoin for what it can do. They hold it because they hope the price will rise. That's the hallmark of speculation, and speculation works until it doesn't. Once the hype dies down, there is often nothing left to sustain demand. This difference between speculation and value is crucial for investors to understand. Wealth is built by owning assets that generate cash flow, appreciate in value due to real-world demand, or provide long-term utility. Speculation, on the other hand, is about short-term price swings fueled by excitement and momentum. Dogecoin's history shows that it thrives during hype cycles but struggles to maintain growth once the excitement fades. That doesn't mean people can't make money from it. It simply means that relying on Dogecoin as a long-term investment strategy is risky and unsustainable. Recognizing this truth helps investors set realistic expectations. Dogecoin is not a guaranteed path to wealth, but rather a speculative bet with uncertain outcomes. The most practical way to think about Dogecoin is through a balanced investing approach. For many people, the mistake comes when they treat it as a primary wealth-building vehicle, putting in more money than they can afford to lose. That mindset turns excitement into danger because Dogecoin is not the kind of asset that offers steady returns, predictable growth, or reliable income. Instead, it behaves like a speculative bet, sometimes rewarding early movers but punishing those who enter too late. A balanced approach means recognizing both the risks and the opportunities then deciding how to place Dogecoin within a diversified portfolio. Diversification is a principle that protects investors from unnecessary risk. By spreading money across different asset classes like stocks, real estate, index funds, and maybe a small slice of crypto, you reduce the chances of one bad bet destroying your financial future. In that context, Dogecoin can fit in, but only as a small portion investment, more like a side experiment than the main course. Think of it like this: if 90 to 95% of your investments are in solid, long-term assets, the remaining 5 or 10% can be reserved for higher risk opportunities, including Dogecoin. That way, if Dogecoin skyrockets, you benefit, but if it collapses, it won't derail your overall financial progress. Another important part of a balanced approach is setting clear expectations. Everything makes a good investment. Many investors lose money not because the asset failed, but because they invested without a plan. If you're going to buy Dogecoin, you should already know how much you're willing to risk, when you might take profits, and at what point you would walk away. This discipline helps keep emotions out of the decision-making process, which is especially important in markets as volatile as cryptocurrency. Without a plan, investors often get caught up in fear of missing out when prices rise, or panic when prices fall, both of which lead to poor financial outcomes. Ultimately, the truth is that Dogecoin is not the villain it's sometimes made out to be, but it's also not the miracle investment many hope it will become. It can be part of an overall portfolio, but only if approached with caution, discipline, and perspective. Treating it as a speculative side bet rather than a core holding is the best way to balance risk and opportunity. By doing so, investors can enjoy the upside potential without putting their financial security in jeopardy, ensuring that their long-term wealth isn't built on unstable ground.